I've just recently bought into some Australian corporate bonds. I'm very new to it all. And in hindsight, I'm a little bit concerned about, the potential raising of rates in the US. What impact does that have on bond prices in Australia?
So Richard, the question from Clive was, he's just bought into corporate bonds. He's now a little bit unsure because of the threat of US rates going higher this year. And what will it do to his corporate bonds?
That's an excellent question. That's actually a question we receive all the time. Essentially, if I can read into your question, Clive, it's why would I buy fixed coupon bonds if I think rates are going to rise, driven by offshore rate rises? Will there be a rate rise here? We're doing another study, and we're about to publish this on that very question, because it vexed our mind, or exercised our mind rather, in terms of should we do fixed coupon bonds or should we do floating rate bonds? In the end, we're going to do both, and our next sort of cabs off the rank will include floating rate securities. But on the question of the fixed rate bond, which I assume Clive has bought, I think you've got to look at, and the way we've looked at the study is, well, what's the market telling us right now? So we looked at short-term futures. Short-term futures say that in the very short term, talking about the next 6 months, there's a likelihood of another rate cut before there's a rate rise, and rates will only start rising into next year. Then we looked at longer term, the government bond curve, threes and tens, 3-year government bonds and 10-year government bonds, where there's a reasonably flat curve. It's not completely flat, but it's not saying that the cash rate is going to be dramatically higher. So that suggests to us, well, have a look. That's the professional market saying what it thinks. But notwithstanding that, then we looked at a range of scenarios where, well, what if there's a 25 or 50 or 100 basis point or 1% rise in a term deposit rates, and therefore the term deposit? Would I be better off staying in the term deposit and just rolling from term deposit into term deposit as the rates increased? And the study kind of surprised us again. This is why we're publishing it, in that because of the higher yield available, the higher carry, as they say in the professional market, available on the bond, it provides a level of protection from a certain amount of rate rises. So if there's a very steep rate rise, that's not anticipated market, but if there was a steep rate rise, say 4% in 2 years, or 2% in a year, or something like that, which hasn't happened for quite a long time, then yes, indeed, you'd be better off staying in the term deposit and rolling up the curve. But have a look at the yield on your bond that you've bought, and you can actually do this analysis yourself, because when we publish this, you can have a look at how we went about it. It's not actually that difficult, and actually calculate, well, how much, what the risk you've got, what is the risk of, and how much would rates have to rise before I'm better off staying in the shorter term, say 3 or 6 months term deposit.
We'll go for a quick break.